Welcome, everyone, to Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with the program, my guest and I will cover every angle of real estate under the sun, from interest rates to the economy to what's happening in Washington. Anything that affects our local real estate market, we will cover here. If you got credit issues, you can call me. If you're looking to buy or sell a home, you can call me. If you want to refinance to the lowest rates in U.S. history, call me. If there's any questions that you have regarding credit, real estate, finance, I'm your guy. The number is 877-245-2030. That's 877-245-2030. That's an off-air phone number. Make sure you join us every Monday from 2 to 3 p.m. on WNEW 1580 AM, from 2 to 3 p.m. in the afternoon. And like I said, if you have any questions, the off-air number is 877-245-2030, or reach out via the web at realestate360live.com. That's realestate360live.com. Remember, if it's real estate, it's covered here. Got a great show lined up for you guys today. Joining me on our panel to discuss what happened in the markets last week as well as what's going on in the markets this week is Louis Cammarosano, who's the general manager of HomeGain. Louis is often cited in the media as an industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, Smart Money, MSN, and numerous others. Like I said, we're going to let you know what's going on in the markets that can affect you and your real estate decisions. Louis, how you doing today?
I'm all right, Ryan, and yourself?
I can't complain. Just another day. It's a little drearier out there today. It's been raining for the last 2 days, so it's not that great. What's the weather like there out there in California?
It's about the same, chilly, overcast.
Yep, about much of the same here too then. So we got
Monday weather.
Yeah, wonderful Monday weather. Makes it easy to get up in the morning. Big thing got going on this week is the Fed meeting. We kind of touched on it last week, but the Fed's going to meet again, and most of the analysts are predicting that they might actually opt for another round of quantitative easing, which would be the third round of that. It's interesting because I'm not really sure what to make of this. I mean, I almost feel like with the amount of buying of our treasury bonds and mortgage-backed securities that's already going on, they already comprise for probably 2/3 of that right now. What is another stimulus actually going to do when they're already buying the majority of the debt anyway? I really don't think that it's going to do that. And their argument is to keep interest rates low for an extended period of time. Well, they've already been low for an extended period of time. All the circumstances of what's going on in Europe, Greece, Italy, all those other European countries is really taking money out of their country and the stock market, and money's flowing back into the bonds. And I feel like that's going to be something that's going to continue on for the next year or so. I really don't feel like a stimulus is going to do much in the way of making interest rates go lower or actually making them go higher. What's your take on that? Where do you think things are headed?
Well, I would agree that there's never been a need to do the QE1 and 2, but I don't think they're going to do QE3. As you mentioned, a lot of capital is flowing into the U.S. because of the problems in Europe. And indeed, there was an article in Bloomberg today that economic forecasters believe that the dollar is going to strengthen. So whether that's a well-founded belief, that seems to be where people are headed, that the dollar is the place to be in spite of our debt problems. So there's really no need to do QE3 because interest rates are going to remain low. And as you mentioned, the Fed is buying U.S. Treasuries in any event. So I think if they were to do QE3, there would be a positive reaction in the market, but there might also be some kind of panic that somehow the economic recovery hasn't taken hold. It hasn't. But if they were to actually announce QE3, I think you'd see a rise in oil prices, and also it'd be an admission that unemployment really isn't getting better, even though they're saying that it is. Yeah, so I think they want to lay off the QE3, even though they want to do it, until after the election.
It's funny because a lot of the, stock analysts and stuff are saying that, this is a necessary evil, and we need to have this because to prevent the stock market from falling off a cliff. And the earnings reports for quarter one, they have not been as soft as originally thought. So that would obviously give some sort of indicator to the Fed that things are strengthening up a little bit. But it's kind of interesting because the stock market is Dow's close to 13,000. I really think that that's way too high to begin with. I really don't feel like where we are as far as an economy And we're nowhere near those numbers. I think that's actually present in the stock market. I think that
You're saying they're not justified based on where the economy is.
yeah, I just feel like there's I think a lot of that is institutional buying, more companies buying than actually your average investor.
Well, I think it's also because the average investor is hamstrung by two things. One, they don't have the money, and two, if they do have the money to save, there's no point in saving it because you don't get any interest, so they're forced into the stock market, and the companies are in the same position. They have nowhere to put their cash. They don't invest it, so they buy their own shares. So you basically have this artificial environment where people are buying shares because there's no place else to go, and I think that's kind of what the Fed wants.
Yeah. Yeah, and I think that that's definitely what's been taking place over the last few months. Also, some other things that are on deck this week include the March new home sales, consumer.
Which, by the way, Ryan, which is interesting is if you really wanted a strong dollar, you'd want people saving their money and investing in treasuries. Instead, the Fed does that investing by printing money out of thin air and buying the treasuries, and they leave the rest of us to purchase speculative stocks.
Yeah, and by them printing more money, they're devaluing our dollar. So it's counterintuitive to what they're actually, a lot of analysts are saying it's going to, the dollar's going to strengthen. It might strengthen in relation to the euro. You know what I mean? The euro has actually been dipping down every single day.
Right, but it's not strengthening in relation to oil, gold, and silver.
Correct.
And other commodities.
Which are things that you and I tend to focus more on than anything else. Is the gold, looking at gold prices. And I think, gold is tremendously still undervalued. Wouldn't you think so?
I would think so, only because the amount of gold being mined isn't going up at the same rate as the amount of money that's being printed.
Yeah, absolutely. Later this week, there are also going to be the March new home sales report, consumer confidence, and durable good orders. Those are all key data points, like I said, that can move markets one way or the other. I really don't think that anything is going to be too much of a mover. Like I said last week, the Fed meeting will probably dominate the news this week, and it will dominate what you'll see. You'll probably see a lot of fluctuations in the stock and bond market. So it is important. Obviously, if you're considering buying a house and you're trying to figure out whether you should lock in your rate or float, or you're trying to refinance and you're not sure what to do, it's always a good idea to get in ahead of this meeting, because really whatever comes out of Bernanke's mouth can literally push the markets one way or the other. I've been saying this for a long time, that I really feel like, we've hit these levels where the 10-year bond is like 1.93. It gets to a certain point and it kind of stops, and we haven't seen that drastic move lower. It tends to get to a certain point, and then all of a sudden rates shoot back up. And then everybody's like, oh, I missed the low interest rates. The best thing to do is, don't worry about an eighth here or there. I mean, obviously, you're always going to be able to. You can't. Nobody has the crystal ball, and they can't predict what's going to happen in the stock market. You can't predict what's going to happen in the mortgage-backed security world either. It's a dangerous world out there, because it's very volatile. Things can change 3 to 4 to 5 to 10 times a day. And I think it's interesting to note, because a lot of the time when you have people researching on the internet where interest rates are, and there's a quote that's given out by an internet company, whatever it may be, you have to realize that some of these quotes are real time and some of them aren't. But literally in a span of 10 to 15, 30 minutes, you could have a change of an eighth or a quarter of a point in the interest rate. And all of a sudden, when you thought you were going to lock in, you go back to them a day later, that rate no longer exists. There's a reason why, because rates are changing that fast. I think a lot of people out there are under the assumption that, rates are kind of just, hey, what's the rate today? That's the kind of the question they ask. But really, it's what is the rate as of this very minute? And it's very important for you to understand, if you're out there shopping for a mortgage, that these things change quickly. And that if you're happy with what you're getting at that point in time, there's really no sense in risking, the rate fluctuating upwards another quarter of a point. You might as well go ahead and lock in your solid rate, which are at all-time lows. There's some articles out there that right now, and I want to say probably 97 of 100 major cities, that it's actually cheaper to buy than rent right now. And we've actually looked. There was an actual graph that was given last week. I can't remember what newspaper showed it, but it was showing the rental price increases across the United States. And the D.C. metro area, Baltimore and Washington, D.C., were amongst the highest there, which were probably anywhere from 5 to 7.5% increases year over year from last year. Louis, you and I have talked about this numerous times. I think this is going to be a continuing trend, especially in areas, metropolitan areas, where there's a high supply of jobs. I
agree, and it's also going to be a trend where people who want to buy can't buy because they can't get the mortgage, so it forces them into the rental market. And there's also a psychology that renting is better than buying. That drives the price of rental units up, which means if you're a good contrarian and you lock yourself into a 30-year fixed rate at a low rate and you buy, you might be better off over the next 5 or 10 years.
Yeah, absolutely. I mean, and it's not necessarily like, I think a lot of people out there think that it's, renting is the cheapest option. That's the cheapest way to go, just as far as outlay, meaning everybody thinks that when they're going to buy their home that they have to put down 20% or 5%. That's a common misconception, and really there are tons and tons of programs out there for first-time home buyers. Most of them are from, the local or state municipalities that offer a subsidized down payment where they actually can, they'll grant you a gift of that as long as you stay in the house for X amount of years. What I would tell people is that, when you go to rent a property, you still have to put the first month's security deposit up and the first month's rent. So, let's just say that's $2,000. You might end up putting out $4,000 in that first month just to rent that property. That's going to secure you in for maybe 1, maybe 2 years. And then at the risk of after that term, it can go up even more, whatever the market bears at that point in time.
Oh, sure, because most leases are not long-term leases.
Nope.
They have renewals in them. And at the end of the renewal, your rent may go up, whereas if you have a fixed 30-year mortgage, you at least know what that payment is monthly.
And what I'm seeing right now, Lewis, is a lot of the actual landlords right now, they're getting smart. They're realizing, hey, we're really in control of this rental market right now. They're doing, if somebody does want a long-term lease, if they want a 2 or 3 year lease, basically where they have their rent increasing 5% every year. So that, you can start at $2,000, that's fine, but year 2, it's going to go up 5%. And then after that, it's going to go up another 5%. So, these are trends where they're starting, the investors and landlords are getting in control of the situation. They're able to really dictate what goes on in the market. And I have an inkling to believe that this is going to be a continuing trend over the next 3 to 4 to 5 years. I think rents are going to continue to rise very rapidly. As I've stated before, in the D.C. metropolitan area, we have a very low supply amount of homes on the market to be sold as well as actually to be rented. So there's tons and tons of people out there that are looking just for shelter in general. But the cost, whether you're going to rent or you're buy, you have to look at it. And your cost of renting is going up day by day. Then the cost of actually owning a home, in most cases, is tending to be lower than renting right now.
Sure, and in an uncertain labor market, especially for first-time home buyers, people out of college, they may delay buying homes, which means they're going to be in the rental market. And you may get college kids out of college, instead of buying a home in 3 to 5 years out of college, they may delay that. They may team up with others and rent for quite a long period of time, which puts pressure on the rental market, meaning there's more people looking to rent than there are to buy.
Yeah, and
which makes it a good deal to buy. But if they don't have the job or they're uncertain in their employment status, then they can't buy. Right.
Yeah. And I mean, that's the that's the situation. And it's even tough for them to be able to go out and rent a place when they don't have a job either.
That's true. But what they can do, which they generally wouldn't do in terms of buying, is they can get 3 or 4 roommates.
Exactly. Yeah. Or they can have parents co-sign for the lease.
Correct.
Do something in that terms where it's like, they're going to be more lenient as far as the income that they have at their disposal to be able to qualify. When if you're going to apply for a home loan, obviously you need to hold some sort of job, or as we discussed last week, you need to have an offer letter from a company showing you're going to have some sort of income coming in the next 90 days.
Right, and friends can often live with somebody who has the job.
Yeah, absolutely. And starting out, I mean, obviously, you've got 3 or 4 friends, it does make your cost of shelter somewhat, inexpensive. But if let's just say there is a situation where, one or two of the friends actually does have a job and they have the ability to potentially buy a home, it would make that payment and the overall rent that everybody's paying out cheaper if one or two of the people could afford to buy that home and rent out those other rooms.
And eventually that'll happen, but it does indicate right now that the American dream of home ownership is in jeopardy because of the current labor market, especially for those college graduates are coming out with enormous student loan debt, and their ability to take on more debt to get a mortgage is somewhat limited, especially if they don't have a job.
Absolutely. You actually sent an article, Lewis, on 1 in 2 new graduates are jobless or underemployed. And when we come back from the break, we're going to discuss, what that means to the overall housing market, that 1 in 2 new graduates are jobless or underemployed when we come back. Stay right there.